Of course, life wouldn't be normal if you didn't have some sort of technical difficulties throughout the year. And this is one of those years where I guess I'm going to start off with some technical difficulties. I'm looking, let's see, share, add a video file. Where's my screen share? There we go. There we go. All right. So now I got the application window going. Let's see. Here we are. Share. All right. Okay. So I had a few technical difficulties, but I am ready to go. So here we are. Let's see. So I'm going to go into the chat, making sure everybody sees me. Hello, hello. Hello, Mina. I'm hoping that I'm coming in loud and clear. You can hear me. That's what it's all about. So being able to hear me, being able to see me, and having a bit of a presentation as well. So we've got everything going for us. I did a Windows update. I was told to do Windows update by my computer. I did it. And unfortunately, this latest Windows update for Windows 10, get ready for it. It takes several hours for it to update. So if you're going to do the next Windows update, I would recommend doing it overnight. That works, right? So anyways, so I'm glad everybody can join us, and we'll go ahead and get started. And let's see. So I'm going to loud and clear, everybody says. So fantastic. We're going to get started. So this is what it's all about. And I'm just going to go, this is a Q&A. So go ahead and start loading up my Q&A. Hit me up with as many questions as you want. We'll go ahead and get into these questions. But first, I wanted to do a little bit of an overview and, of course, thank our incredible sponsor. So without further ado, let's go ahead and start this thing. There we go. So let's first thank our wonderful sponsor. Oops, turn on my clicker. There we go. Kevin Buddy from Monarch Coast Financial. Wanted to thank once again Kevin Buddy from Monarch Financial. So he's been absolutely incredible through this whole entire thing. And also, can you make sure, can somebody put in the chat that you can see the actual slides? Because last week there were a few slides that didn't show up. So I did a little mock presentation earlier, but I want to make sure everything is crystal clear and you're able to see it. So if you could see it, that would be great. And also in the comments, add your various questions. We'll get into the Q&A portion of it, but I also want to make sure that you can see them. So yes, hi, I see them. Fantastic. Thank you very much, Brent. So yes, TJ, that would be my beautiful wife, and David. So this is great. Thank you so much. So without further ado, Kevin Buddy from Monarch Coast Financial. Just wanted to thank him so much for his sponsorship. He deals with more than one kind of borrower. And of course, there's more than one kind of loan, everything from full documentation loans to alternative documentation loans to investor financing and private money loans. So just about everything from full doc to private money and everything in between, and loads of experience. Kevin has been doing this since 1976. He's been helping out buyers and homeowners and realtors. He's just been there for so many people for so many years, and he's just an absolute treasure chest of knowledge. Anyway, so he definitely has loads of experience. So please call my buddy and your buddy, Kevin Buddy, at Monarch Coast Financial, and have him help you as well and your clients. He can be reached at 949-422-2075. That's 949-422-2075. And our company is Reports on Housing. It's your local real estate snapshot. We don't focus that much on closed sales data because it's very, very hard to gauge where should I go from here based upon what's happened in the past. That's like, it rained like crazy yesterday. Do I need to bring in an umbrella today? That's not, that kind of helps you out, but you know what? It's not really going to help you out. Instead, you need to go to the forecast and find out exactly what the skies look like right now and where the clouds are coming from, all that good stuff. So we're looking out the windshield at the current supply of homes available to show buyers. And we all know that that's extremely low, but that's supply. And we also take a look at demand. That's the last 30 days worth of pending sales, the placing homes into escrow. So based upon the escrow speed, as well as the number of homes on the market, we get the overall velocity of the market. That's the expected market time. If you place your home on the market, when are you going to open up escrow? The shorter that period, the hotter the market. The longer the period, the slower the market, more of like a buyer's market. We're not even close to a buyer's market, and we're not going to be in one anytime soon. So anyways, it's all about setting expectations, and we provide you with the data, and that buyers, sellers, your neighbors, family, and friends, they can't refute it. It gives you strength. It gives you power, and that strength to provide irrefutable data that it's not the same thing as going on the internet and trying to prove your point. This is sound data in the market today. We have reports all over Southern California. And the latest one that came out, and this was along the coast, LA, Orange County, and San Diego, is called More Homes Coming. And I'm telling you, if you have anybody concerned about the number of homes coming on the market, I can tell you the difference between February and March, and it's huge. And is that the peak? No, it's not necessarily the peak. The peak is later on, but that's what this report drives home, is when more homes are coming on the market. That's what buyers care about. That's also what sellers should care about as well, because there will be a change in the speed and velocity of the market based upon the supply of homes and what's going on with interest rates. So more homes coming, that's the most recent one. And go to reportsonhousing.com, REPORTS, reportsonhousing.com, click on subscribe, and it comes out every 2 weeks. And there are a load of different ways to get this out. We email it to you. There's a printable version, copy, cut, edit, paste. There's charts. There's an excerpt for social media, Facebook, websites, logs, logs. And it's $15 per month or $150 per year. And you get a month free if you tap into your Irish side and type in the coupon code IRISH, because that's what it's all about. We have St. Patrick's Day coming up. I actually did my genealogy and found out, guess what? I'm Irish. Who would have thought that, right? So this year I'm going to be celebrating St. Patty's with the knowledge that, hey, I've got some Irish blood in me. But anyways, use that coupon code IRISH, and let's talk a little bit. We're going to go into the housing market, and then we'll go back to the Q&A that we have lined up already in the chat. So the housing market, the overall housing market. Yes, I've talked about it before. It is extremely hot, and it has everything to do with mortgage rates. It's also, it's hot because of mortgage rates being so low, but it's affecting both the supply side of things and also demand. So it's been limiting the number of homes coming on the market. So having too low of an interest rate is actually not that great of a thing. You would intuitively think, gosh, that's a great thing, but it's not necessarily what I am rooting for. And as well as gas prices. Gas prices are on the rise, but it is a healthy step in the economy with gas prices going up. So let's talk about the housing supply, Southern California housing supply, and Southern California active listing inventory. We did this last week, and this is where it was. It was on March 4th, last Thursday, we came in at 15,865. It went down 2% or down 406 homes. So the whole year, the inventory has been going down, and that's what happens during winter and especially this winter, it usually stays about the same, but it's gone down because of how low interest rates are and how much demand's out there. So we were actually placing homes into escrow faster than they're coming on. And that's why we had the inventory come down. Last year, we were at 28,555. That is 79% more than where we are today. We could definitely use more inventory. And then today, 1,865, no change. That's right. It hasn't gone down at all. There's no change from a week ago. So this is the first time we've been going down every time I've looked at it. And the first time that I'm crunching the numbers in, it's actually no change, which means next week I'll be bringing you the first rise in the active inventory because we're going to hit spring. Spring begins Sunday when we spring forward. That's really when I say the spring market begins for us, because we have that time change. It's pretty much, if you round up, it's spring, which is really a week from, tomorrow. Close enough, right? So the inventory is just at a record low. We've never been this low since I've been starting to track this thing in 2012, and it was a lot higher prior to that. So in order to find an inventory this low, you'd probably have to go back decades. It's the lowest level since tracking. And as far as demand, SoCal demand is concerned, this is the last 30 days worth of pending sales. And this is where we are right now. And this on March 4th, a week ago, 19,060 was up 2%, or 454 pending sales in a two-week period of time. Last year at the same time, we were at 16,785. That is 12% less, or 2,275 fewer pending sales. So we're much stronger, even though our inventory is so limited. Today, we're at 19,385, up 2%, or up 325 homes pending sales. So that's actually, it's going up. It's going up at a pretty good clip, because if you just about double that, you're going to be, and probably by next Thursday will be double that. You can see we're going up at a stronger clip than we were from mid-February to March 4th. So once again, we're starting to see a rise in inventory. It will be above 20,000 definitely next week, or pretty close to that. So the expected market time, this is if you place your home on the market, when are you going to open up escrow? And this is where we were as of last week, March 4th, 25 days. It went down 1 day. So from mid-February, it was at 26 days. Now it's at 25 days last week. And then last year at the same time, it was 51 days, double where we are today. So that's how the velocity, it's like the difference between, and if you understand the difference, it's like going 120 miles per hour. And actually, it's like going 140, because if you slash 140 in half, we're at 70 miles per hour. That's basically half. We're still traveling fast. We were traveling fast last year at 70 miles per hour. It's just that now we're at supersonic speed. And that's the difference between 51 days and 25 days. It's just extremely hot. And today, when I crunch the numbers and look at it, we're at 25 days. It's actually 24.6, so it's slightly down. So I imagine by the time we do this next week, we're going to be at a 24-day expected market time for all of Southern California. It's going to feel a little bit hotter, but we're finally going to get inventory that is on the rise slightly. So the expected market time over time, if you see where we're at, it is by far the lowest level since tracking. So that is where we're at right now, the lowest level tracking. So let's get into it. This is our Q&A session. This is where, of course, I put it on the sold sign over asking Q&A session. It's very apropos, being that it is so hot. So I'm going to look at the chat and see what we can see as far as some questions, and we'll be sure to answer them. Let's see. This is the first one we're going to be showing. It is Nancy. She says, do not see more homes coming on the market. Why? Yeah, you're not going to feel the number of homes coming on the market at first. And there will be more homes coming on the market. And that's what this latest report is that I talk about. And it's different for various counties, but actually we have an increase in the number of homes coming on the market starting this month in March. And then it gets stronger as the spring progresses. And for some counties, that elevation goes all the way through July, and other counties, that elevation of number of homes coming on the market travels all the way through August. So that is something to take a good look at. That's why this latest report points it all out, talks about the differences from month to month, and comparing it to the top of the peak of the most homes coming on the market for what annually per year. This is like a 5-year average. And then what the difference is between March and February, it is humongous. So you've got to take a look at that report to understand there will be more homes coming to the market. And the reason they come on market is because they say it's spring. It's that, I'm going to place my home on the market in spring. Well, spring really begins next week. And like I said, once we spring forward and lose an hour of sleep this Sunday, that's when there's a lot more daylight. It starts feeling like that's when people want to do more, as far as, oh my gosh, summer's right around the corner. It feels like that, and that's where we get into that mode. So let's see, I'm scrolling down looking for other questions. Aha. So here's from David Vera, a good friend of mine. Stephen, where do you see interest rates moving forward? And I've done that on countless presentations. I did that on a prior housing debrief. And what's going on right now is there's going to be far more good news than there'd be bad news. I mean, we're coming out of a pandemic. That was so bad that what it did is it drove the 10-year bonds and the appetite for long-term investments. It drove everybody out of investments and long-term investments. And that's why we saw the 10-year go down to below 1% for the first time ever. There's a traction between 30-year mortgages and 10-year U.S. Treasuries. And the reason for that is the appetite for long-term investments. And so they kind of jive with each other. So what we've seen this year from the beginning of the year is, as we got better vaccine data, as the new presidential administration rolled in, as we got the word of stimulus, that relief package, and better jobs reports for February, different things along the line have really created more and more momentum in the economy. And that momentum in the economy has turned the people away from long-term investments like the 10-year. So, and I think I mentioned, so when things go negative, people like to put their money in long-term investments. I think I said that wrong. So, but when things start getting rocking and rolling in the economy and people are worried about inflation, which I personally am not worried about inflation, we start to get people go into riskier assets and things like that and pull their money out of long term, because their money long term is not going to do as well as short term. So thus is why people make that change. So with that, we are going to see interest rates rise from where they are today. I talked about at the very beginning of the year, we were at 2.65%. We're at a little above 3%. I think I saw a quote from a couple of different lenders at 3 1/8%. We're going to continue to see them rise. As a matter of fact, earlier today, I didn't see where the 10-year ended up, but I know that it was off to the races too today, and there was a bit of a spike. We could see 3 1/4% interest rates really soon, and it might be here today. And where I think that interest rates are going to go, I originally had 3.5% by the end of this year. I'm beginning to think it's going to be 3 3/4%. And the reason for that is we're coming out of this pandemic and we're going into everything going back to normal, but there's going to be increased enthusiasm going back to normal. A lot of job creation, a lot of great things. And I am actually starting to predict a little bit of an economic boom, more along the lines of like the Roaring 20s is what I'm saying. So we're in the 20s, the Roaring 20s. After the Spanish influenza, we rolled into the Roaring 20s, 100 years ago, and here we are. History's kind of repeating itself. We're coming out of a pandemic, and everybody is going to be doing a lot more, and the economy is going to become a lot more feverish, and we could get some short-term inflation. It doesn't mean it's long-term. I'm not too scared about it. It just means that everybody all at once is going to be wanting to consume, and there's a lot of pent-up demand as far as savings is concerned. So we could see a small ride in inflation, and with that, and small increase over time is what I'm saying. And we could see interest rates rise to about 3 3/4% by the year's end. So hope that helps. Let's see. What else do we have here? Here it is. Yeah, well, I think I just answered that. Will Woods was asking a question about the recent $1.9 trillion legislation that was signed by the president. Will it have an effect on interest rates? When there's all this money that's being put into United States citizens' pockets, they've been saving a lot of it, but as we come out of the pandemic, they're going to be spending more, and they're going to be doing more with their savings. So with that, it's going to be more economic activity. It's going to be further positive news for the economy, which translates to the 10-year increasing as people move their money out of 10 years and look for more shorter shorter assets, so short-term assets. So with that, we're going to see that rise in interest rates that I was talking about. Yeah, this is an interesting question, and it's one that's very, very hard to follow. So are you watching or tracking those homes falling out of escrow because of appraisal? I'm not. That's almost impossible for to do unless I did some sort of a survey, that because when they fall out of escrow and they come back on, sometimes they remain in pending and they go back to all of their all of the offers that they had prior and see if there's somebody else that wants it, and then it goes right back into escrow. So you don't really see that much exposure. Some of them come back on the market, but once they fall out of escrow and they go back to active status, there's nothing in there that indicates, oh, it fell out because of appraisal or anything like that. So, but I imagine it's happening to some degree. But when you have a $750,000 purchase price and you have 25 offers and they waive the appraisal contingency and they show that they have money in the bank, chances are it's not going to fall out. And that's the kind of homework that we all have to do. And that's why I say it's so important to price according to a property's fair market value, because you're taking advantage of as many offers as possible. When you take advantage of all the offers that are possible. So when you don't overprice a listing and you price it right where it needs to be, you're going to get more offers on the table. And when you do that, chances are it's going to go above this price. A, B, you're going to get a lot more. You're going to get a lot more favorable terms, and one of those terms might be waiving the appraisal, which I have seen because agents have shared with me their Excel spreadsheet of all the offers that they've received, because who wants to send a seller 25 offers? They just condense it all into a beautiful Excel spreadsheet. And you know how I like Excel spreadsheets. So let's see. Just put a mobile home on. 6 days with multiple Oscars. Let's see. So I am looking for the next question. My buyer sent today and said we were going to wait. Huh. That's funny. So your buyer saw COVID hitting. Prissa, please expand upon what that article says, and I'll try to state how I feel about what CNBC is great. I love it. I follow them quite regularly. They're on their real estate beat. I don't think that they're right on. The gal that does it a pretty good job, but she doesn't have. She's not really following the economics of it all. So I am very interested to hear what they have to say, because I don't always agree with the what the news media putting out there. So let's see. Oh, there we go. Prissa says, will you see this rise in prices going on for another year? Absolutely. So Prissa says, will you see this rise in price going on for another year? Do you think we will see some slowdown in the crazy increase of prices due to multiple bidding? Actually, until we get interest rates around that 3.5 to 3.75%, it really is still a great rate. We have rates right now that even at 3.25% was still, and it's an incredible long-term historical rate. So until I see that rise go to 3.5 and 3.75%, we're not really going to slow down enough. And my analogy has been in all of my meetings that it's like right now we're speeding at 140 miles per hour. So buyers need to understand this. What they're waiting for is for the market to turn. It's not going to turn, it's going to slow. And it's only going to slow from sonic speed, 140 miles per hour, like what I said we're going right now. That's how fast the market is, to 79 miles per hour. And 79 miles per hour is still going to get you to where you want to be at a very fast speed. As a matter of fact, that is still what I refer to as a hot seller's market. When you're going 79 miles per hour, I would say that's pretty much a hot seller's market. So we're going to, even at 3.5 or 3.75%, we're still going to have a hot seller's market. We're just not going to be going at warp speed. We're just not going to get 25 offers on a house. We might get 5 or 6 offers on a house, or 8 offers on a house. It's just at least this will weed out anybody that is not totally interested. Some people will not qualify at 3.5 and 3.75%. These low interest rates were only here prior to today because of the pandemic. And as we come out of the pandemic, it's natural that these interest rates, as the economy thaws out, moves back to where they should have been had we not had a pandemic. So that is where interest rates are going. And the same thing can be said for 10-year the 10-year U.S. Treasury. There was a panic. Everybody parked their money in United States treasuries because that's the safe haven. And now that things are thawing out and going back to business, they're pulling away from 10-year treasuries. So that's it. But that's why we're seeing this rise in interest rates. And it's not a bad thing. It's just, it's not as favorable for buyers. Buyers were wanting for it to slow down. They're going to get that, but it's going to be on the backs of higher interest rates, which makes home affordability drop down a little bit. Let's see. Oh, here's another one. Yeah, Parissa said, that's interesting, Parissa. So you said that it's at a tipping point. This is further to what Parissa said of that CNBC article. The CNBC said that housing market is at its tipping point. I don't understand where they get this. I really don't. See, a lot of them thought that we had all this extra demand because of the fact that we went into the pandemic and there was this big hole. So the second half of the year was making up for lost time. The problem with that theory is it wouldn't keep on going. What I've been looking at is year over year mortgage purchase applications, and they have been extremely strong. We're finally getting to the point where year over year, it's about the same as last year. Of course, now looking at it going forward, probably for the next several weeks, it's going to look a lot stronger than it did in prior years. And the only reason for that is because we went into a pandemic and everything shut down. All of the United States shut down, if you remember. So, but I just see it as, it's not a tipping point. It's just the momentum is pretty darn steady. There's still plenty of activity out there. We have a problem across the United States. There's not enough homes on the market everywhere. And we have values that are soaring. The only thing that's going to make it slow down a little bit is interest rates rising, and that will just accumulate a little bit more inventory as we get some overzealous sellers that will not hit pay dirt and not go into escrow because they overprice. That is what is going to unfold more in the second half of the year. I actually don't see it transitioning to that until maybe the second half of June on. So for right now, it's going to, and I'm just telling you that we're just going to have to do a better job of pricing is really what that's about. That's the only tipping point. The tipping point is you better do a better job of pricing. Otherwise, you're going to sit and you need to be closer to where it needs to sell. Because I know that there's a lot of homeowners that are going into escrow right now, and they are going into escrow thinking, you know what, I could have got more. Or the people that just sold a month ago are going, man, I could have got more. Really, is that what it's about? You could have got more. This market is going to pay out what people really deserve. And when you have multiple offers, you are going to get the highest and best offer for your home, typically. So let's go back to that one. Let's see. I love this one. This comes up in almost all of mine. Buyers are thinking that forbearance homes are going to end up in foreclosure, and I do not see that happening. At most homeowners do have equity. That is the biggest thing. And you can go back to I've done housing debriefs on the wave of foreclosures that's coming. Matter of fact, that was one of my first 4. I answered the bell on that again because their Black Knight did a full on. They did a big analysis of how many people total have gone into forbearance. So 6 million people. How many people have come out? The vast majority of the people that have come out actually are continuing to pay their mortgage. And then there's another big chunk that paid off their mortgage. There's only a small fraction of people that even ended up distressed after coming out of forbearance. That is going to be the story coming out of this. And I can show it over and over again. I could talk about it over and over again, but there's just way too much noise out there. There's a lot of perma bears that can't wait for this thing to collapse, and they've been rooting for it to collapse, and it's just not going to happen. It's just not the storyline. You can find plenty of YouTube articles and things like that, but I could tell you the data doesn't prove out what they're talking about. So I'd love to see their data. So show me their data that they're relying upon, because most people don't have it. Let's see, we are also seeing buyers overbidding, then trying to reduce the price during escrow from the inspection. Yeah, I've seen that stuff. This is typical. There's a couple problems with this kind of swiftly this swift moving market. A couple things: we have appraisal issues. That's number one. Number two that we have to see is definitely the inspections. The inspections buyers already feel like that they're overpaying, and then they get into escrow and then they see all the things that need to be done. This is why you need to expose your home to as many buyers as possible, have it listed at the fair market value, have 25 offers on it. So when that happens, because it happens often, there's these different excuses, you can switch it out with one of the other 24 buyers that didn't get the house, and they'll be a little bit more motivated because they're second in line out of 24 people. So that's part that comes hand in hand with this darn crazy market. So once again, this is what happens. We have appraisal issues. We have to deal with that by making sure that people have enough capital so that they can waive the appraisal contingency. And that's what happens. You know who gets burned in this? It's the buyers with little down and not a lot of money in the bank because they can't waive appraisals, which is why I want this market to slow down a beat. We're just going too fast because it's hurting the people that are struggling, that I think really need the help. Let's see. I have a buyer who is pre-qualified. I love, oh my gosh, everybody's afraid of this. Fear drives the market, but unfortunately, there's not enough fear out there to make the markets totally shift. But there are a number of people like this. Frances has a buyer that she's working on. I have a buyer who is pre-qualified, is afraid not being able to afford a home in the inland empire. He's afraid the market is going to tank. Seriously, I'm here to tell you right now, not gonna tank. This market has way too many legs. You've got to look at my video that I did, Not a Bubble. This is not a housing bubble. The market fundamental pillars for housing stock are so strong. Everybody had to qualify for their loans. Everybody had to put sizable down payments. Everybody had to they had to outbid other people in this marketplace, which creates even more people buying with cash or sizable down payments. They're not using their homes as piggy banks. That can be proven. I like Logan actually said, I wish they did more of that because it would help the economy go a little bit even more. I'm sure that's what his thinking is. Logan Motoshami, I mentioned him. He's fantastic. He writes for Housing Wire now, is retired and in an enviable spot. Just a good guy that knows a lot about housing and has plenty of charts like myself. We all follow lots and lots of charts. And unfortunately, Francis buyer is like so many buyers. You can find plenty of articles, YouTube posts, everything that talks about when the next housing crash is going to be. I can create a Facebook Live and call about the housing crash. I'm telling you, I will get more people that will watch that than I will when I start talking about interest rates. So that just shows you what everybody's talking about. They'll click on it, and there's some people that say, yes, the housing crash is going to happen. It happens every 10 years. There's no timeline to any kind of a crash. It's not going to happen anytime soon. So we just have to get off of that soapbox and continue to feed them information like what I have provided. So go to one of I have them all housed at youtube.com/reports on housing, are all my old housing debriefs. You should sit your buyer in front of that so they understand real economic sound housing model will beat out all the other perma bears out there that are just rooting for things to crash. So let's see. Wow. Yeah. Let's see. Brent. And I know this one's going a little bit longer, but this is Q&A, so we're just going to keep on going. If you don't have time, you can watch the rest of it later, all that good stuff. But I just want to bring you as many answers as my head can provide before I start swimming completely. But will rent relief for owners create any sales where they are tired of being a rental property and not getting rents from the pandemic downturn? That could be the case. As a matter of fact, I definitely see that could be increase the pool of sellers that are out there, but it'll only be the case for a small portion. People also have asked me, Prop 19, how much is that going to move the needle? Well, so far, not much. And it's what I said was going to happen before. I really felt that, yeah, there will be more people that will participate because of Prop 19. That's where you can take 55 and older. You can move to any county now. You can actually move up in price or down in price and bring your tax base with you. If you go up in price, you bring your tax base, and then there's a calculation for the higher amount from what you sold your prior home at. But you could do that more than once now. And what's so great about that is it allows 55 and older, I'd say it's seniors, but I'm getting too close to that. So 55 and older human beings to move more than once. And theoretically, it should create more people that come on the market, but it's just not going to move the needle enough where you're going to feel it in the marketplace. There will be more, but it's like the difference in a county of going like adding an extra 150 listings across all of Orange County or 300 in all of LA County. It's just not going to move the needle enough where you're going to be able to see the difference. It will help a tiny bit, but not enough. So let's see. I see Robert said, Steve. Let's see. Any other questions to have? Here we go. We've got one from Aristotle. Hi, Stephen. What do you think about landlords that have non-paying tenants? Do you think we'll see some of them selling so they can get out from under it? Yeah, there is a in California, if you work with your tenant, you're basically going to forgive all the past what's owed, and the state of California will send you a check for 80% of what you're owed. So that's working with the tenant. Now, the option that I think a lot of landlords are going to go with, because that, of course, is accumulated over time. So there are programs in the works here in California, across the United States. There's going to be more landlord relief that will actually keep them whole, and we won't see this a whole bunch of them wanting to sell in the future. So I actually, like I said, I don't think that that's going to move the needle enough. There will be some people that are going to say, I'm done with this, and be out of it. Yes, I like that. David says, strongest buyers get fed first, leaving weaker buyers to pay most at tail end of boom. Then they're first to get washed out in downturn. David Baum, said, strongest buyers get fed first, leaving weaker buyers to pay most at tail end of boom. Then they are first to get washed out in downturn. I don't necessarily totally agree with that. It just means that they're not going to ride as much of the equity wave. But it's the best analogy I can give you is there are a whole bunch of great sets in the ocean if you like to boogie board, body surf, go out in the waves, or surf. There's a whole bunch of sets. You get to the beach late. It doesn't mean when you get there and you feel like you're the weaker buyer and that you're not going to be able to take advantage of the sets, you go out there and then sure enough, you're on your board and you still get plenty of wave action. That's what I project is going to happen, even if you ultimately don't hit pay dirt on purchasing a thing later on to this year, but you really give it your all this whole entire time, and we get to the summer and then finally you hit pay dirt. Well, yes, you did miss out on some appreciation, but I'm here to tell you that we're going to have continued appreciation going forward. Maybe not at the same exact speed, but you need to get into the market. You need to get in the real estate market, take advantage of these low rates. Anything below 4% is going to be a great rate, period. And so I would get in and paddle out and ride as many waves as you possibly can. And in the unforeseeable future, I do not see the housing market changing time soon. So do not hold out for that buyer's market. It's not coming anytime soon. The sooner you get in, the less you're going to regret it down the road that you didn't get in soon enough. So that's what I have to say about that. Let's see. Robert says, I'm in a market that is year over year, January through March 12th, activity units sold half of where they were last year. Even with interest rates today less than where they were last year at this time, the total dollars transacted and units sold is off by 50%. Will affordability today's record today's record high prices actually in combination now with the rising prices result in a smaller in 2021 in comparison to 2020. So Robert, this was good and it cuts it off, but I'm here to say that I have to hide it in order to totally see it. So the price results, it really does ultimately boil down to supply and demand. Your demand, San Diego's having the biggest problem with this. San Diego is actually has fewer pending sales right now in the last 30 days than they did last year. And that's because they really have not placed enough homes on the market. And that is because they're having this issue of, but there's nothing to buy. So it's keeping homeowners in their homes. It's not COVID that's keeping them in their homes, because I'm here to tell you, in the month of December, in the middle of a COVID pandemic, San Diego County put more homes on the market compared to the 5-year average. So it's happening in January and February. And I know January is off 21% in San Diego, 19% off in the terms of the 5-year average in number of homes placed on the market. And that's a lot of missing homes. It's 1,700 missing homes across San Diego County. So that's creating a big issue in San Diego County. So you're just limiting the number of closed sales and escrow activity at this point. That will change, and I'm sure you've seen my latest article. So we will see more homes come on the market, which will help alleviate this issue a little bit. And as interest rates rise, there will be a rise in the overall inventory. And at that point, we're going to see more and more transactions as well. So you just have to be patient with this market. It is a crazy market, but I do anticipate values to continue to skyrocket just because of the number of homes available in San Diego County versus the gigantic demand. So and I know that's what's going on because I've seen the expected market times in your area. Pretty much most of San Diego County is dealing with a lot of markets times in their teens, which means that it is instantaneous. You get offers, lots and lots of offers. It sells for above asking, and we have values going up too high. So I actually think that the rise in prices in 2021 is going to be just as robust as the second half of 2020. And so Olivia asks, what are the stats on forbearance? And off the top of my head, 2.6 million people are currently in forbearance right now. It was over 6 million that have taken advantage of forbearance. The vast majority of them are paying their payments, or they are they're making their payments, or they paid off their mortgage completely. There's only a small fraction that are even distressed. Most of them have plenty of equity so that they can go ahead and sell their homes. And push comes to shove, many people are selling their homes. So that's where the stats are for it. On my wave of foreclosures live, that was a couple debriefs back. So you can take a look at that on youtube.com/reports on housing. And the stats for unemployment, everything is dropping too. We're at 6.3% unemployment. That will continue to get better. Most of those people are in the service sector that are going back to work right now. And there's going to be even a bigger punch, I think, in March as more and more people come online. It's the lower tier unemployment. It's the lower tier income level earners. That are more unemployed. It's the unemployed is made up mostly of the people in the lower income brackets, the people with less education, the people with that are younger. So that combination sounds like renters. So it affects a lot more renters than it does homeowners. So disproportionately. So you can say that you could be a little more concerned about landlords, but a lot of the relief that's coming is going to be coming in the form of helping out landlords as well as renters. And there is rent relief going on as well with this latest relief package. So I anticipate as we get more and more people vaccinated and the numbers are looking a lot better, we're going to go back towards full employment. I think that we'll get back towards that full employment by the end of sometime in 2022, but the numbers are going to look a lot better by the time we get to 2021. At the end of 2022, we might even see numbers where we were prior to the pandemic, which were already at record low unemployment. So we could get back to that as well. Let's see. I'm continuing to go. Let's see. Does your data show that the investors are out of this market and only the occupied are fighting to get into a home? Yeah, you can't. This is, I get this commonly. I can't really tell, Parissa, if I'm dealing with investors or owner occupied are fighting to get into a home. Really, ultimately, it's the person, when there's this many offers, unfortunately, it's survival of the fittest that typically gets it. You hope somebody throws a veteran a bone or a young family with a baby a bone. But I know, because my hairstylist I've been talking about is young family with a baby, and they've written like 7 offers so far, and they have a great story. There are so many great stories out there. At the end of the day, a lot of sellers are choosing just to go with the strongest offer, which seems to be the highest down payment, people with money in the bank, people able to waive the appraisal contingency. And there's still opportunities in this market. I've seen homes that need fixed, and people are still not able to visualize. They might not get as much for them, but once they turnkey, they turn around and they make these things sing, they can get really great values for these houses as well. So, and I've seen that. We're just not going to see as many investors taking advantage of this market when it's this hot, but we'll see them back in the future. Let's see. Is there ever a time when you recommend that a buyer not buy? If so, when? Yeah, typically. When we went into the Great Recession, I could see that in 2016, I could start to see the cracks, and the market was still going up in value, and it was only because of subprime and everything. My issue was inventory was really high. And that, when you have that much inventory, there should be no reason why there should be anybody clamoring to purchase or paying top dollar for homes. And that was a time, 2016, 2006, 2007, 2008, those were not the years to be purchasing something unless you got a heck of a bargain. Then it translated to first-time home buyer tax credits, and that we had a couple of them during the Great Recession. And then in 2010, everything was looking good. By the time I got to 2011 and 2012, if you looked at it, if you looked at purchasing, it actually was better than if you wanted to turn around and buy something and rent it out, it was cash flow positive. And when I saw that across Southern California, I knew it was an excellent time to buy. And that was the beginning of the run, was 2012. And it really, you could see it in the works in 2011, just like I could see it in 2006, 2007, 2008, but I saw it as early as the fall of 2005 is when I started reporting initially on cracks, and that's where there's a little more hesitation. So, but as far as all the economic charts and data are concerned, we just don't see it right now. That's why I'm recommending that buyers buy, especially with low interest rates. Let's see. Oh, we just answered that. Percentages of California leaving. That's a good one. Mitch says, percentage of sellers leaving California. There are a lot of homeowners that are placing their homes on the market and leaving California altogether. This has been the story since I got into the business in 1991. I always heard how people are moving to Texas. Now it's not just Texas. Now there's other people. Now there's other places. It was Texas. It was Arizona. Now I hear Nevada. Of course, I hear Idaho. I've even heard Montana. You hear of all these different places that people want to move. I think there's a lot of great places for people to live. But there's so much demand here for Southern California that I don't see it really as a big problem. And there will be plenty of analysis on this, the net number of people that have left, and that includes babies being born and all that stuff. It's such a small fraction of the number of the people that leave. Yes, the stories are everybody's leaving. I've seen a lot of people leave. This is the opportunity too for people to relocate to wherever they want to be close to family and all that stuff. And the circumstances for the real estate market, this is a really good time to do something like that. So we're going to see a lot of people take advantage of that, but we have plenty of people on the market right now. Tennessee, that's another one, Brent. Yes, that's another big one. Tennessee, there's a lot of them that are out there right now that people are moving to. But you know what? At the end of the day, we need more inventory. We just don't have enough of it because there's not enough people that are moving out of the state of California like everybody's talking about. So, yeah, I've done that. So that's interesting. I'm not really tracking. I do track closed sales. There's a lot that go through the county recorder's office and not in the MLS. A lot of those are for sale by owners. Those are also new homes. It's such a small fraction of everything. I've been doing the same thing for a long time that it really doesn't matter that much. A lot of agents actually sell theirs prior to coming on the market. But guess what? I've noticed over the last year, a lot of agents still put it into the MLS as comps. And they also want to get credit for it for tracking purposes and everything else. So you've seen a lot of homes. You can go back and see all these that have 0 days that really were exposed the market to anybody, yet they still place it in the MLS. So just take a look at January. You can watch the closed sales. This is why I can't deliver the closed sales until February, till like March 10th. It takes a long time for it to get in there. And then the numbers, I have to go back over time because they actually change. There are some that are sold outside, but it's just not worth tracking. It's of course a big bummer, but that is going to change over time as the market velocity slows a little bit. And for sale by owners and doing things outside of the MLS absolutely does not make sense. So let's see. Yeah. Aristotle says there was an article that shows that there was not a mass exodus in 2020 as people thought. I know Jonathan Lensner follows that very closely. It's very, very interesting. So Karen says, I've represented more buyers coming into California last year than sellers moving out. See, everybody has their own anecdotal story too. North County, coastal San Diego, getting lots of buyers from LA, Bay Area, and New York Metro. Yeah, this is actually interesting. And I'll finish on this if I don't have any more questions. This has been a long one, but hey, you know what? This is your opportunity to ask questions and answers, and that's what it's all about. So North County, David was talking about this. Yeah, actually, along the coast, I've talked about this. San Diego is the biggest bargain if you're looking for coastal homes. And Orange County used to be the biggest bargain, but their values have been coming up. So LA is the most expensive, then Orange County, but Orange is not looking as much as attractive price-wise as it used to in the past. Now you slide over to San Diego. I went to school at UCSD in La Jolla, and I'm telling you, such a pretty campus, such a pretty coastline. Here, you can work anywhere. So there's a lot of companies that are relocating to San Diego for this very reason. There's a lot of the wealthy that are moving to San Diego County for that very reason. Their money packs a bigger punch. So they look all along the coast, and there are a lot of people leaving Los Angeles County around. I've seen it where the year over year upper range around Beverly Hills, West Hollywood, all of that area, downtown San Diego is having some real issues. And they actually have a slower expected market time than a year ago, that type of thing. The only reason why, and they're one of the only high-end markets that I'm seeing that in, and that's because of this whole notion of I would like to work someplace else. I don't want to live in Los Angeles County anymore. I'm seeing that to a slight degree in Los Angeles County, and that's why their expected market time is a little bit lower. That's why their inventory actually is a little bit higher than some of the other inventory levels across the Southern California plains. So, anyways. Here's the last thing. I'll leave it on this. This is interesting, Todd. Why is Palm Springs going so crazy? Thought it was a secondary market. You know, when you can pretty much Zoom from any place and work from anywhere, I could work, if I didn't have all these kids, I could work from Palm Springs if I wanted to and just thaw out and live poolside and just live a great life, you know, that type of thing. There's a lot of people that are moving, and this is part of that thing with get a smaller place in you know, if you're along the coast, and if you took your money and transplanted to Palm Springs, your money goes a lot further, and you can work from just about any place. And there's a lot of people having that epiphany, and that is what is going on. It's not just a secondary market anymore. We've got people that are relocating out there, and their market is incredibly nuts. It's pretty much nuts across Southern California. So I can't really say that it's just nuts there. It's going crazy everywhere. And it's not just Southern California. It's across the United States. I'm right now doing a slide that I put together just talking about how crazy the market is in every corner of the United States of America. Anyways, thank you so much for staying tuned. My head is beginning to explode. I'm sure yours is as well. I appreciate this. We'll be doing Q&A sessions down the road, and we'll just jam to our Q&A sessions. I thank you all for participating. It was a lot of fun. And let's see where we go from here. Let's see this next slide. Of course, reportsonhousing.com. You go there, subscribe, and it is $15 per month or $150 per year. You get a month free if you utilize the coupon code IRISH. And let's see, there's the coupon code IRISH. And we do have a referral program. I wanted everybody to know that if you send us a referral, you'll get a free month. If you send us somebody that signs up, we'll get you a free month. So you won't, even if you are on an annual, if you signed up for a year, we'll give you an extra month. So if you were due to come up on your annual in 2 months from now, we'll just add another month. It won't be for 3 months from now. So send us somebody, and just if somebody signs up and you send us that person's name, or that person says, hey, this person recommended me, we'll give you a free month. That is our referral program. So please utilize that. And I want to thank Kevin Buddy, my buddy and your buddy, Kevin Buddy from Monarch Coast Financial, deals with everything from full documentation loans to private money loans and everything in between. And he's been in the business for a long time, loads and loads of experience, such a great guy. He's been around since 1976. And Kevin Buddy, you can reach him. He can help you at Monarch Coast Financial, 949-422-2075. That's 949-422-2075. And that's all I have for you. Sorry this was so long, but you know what? I had so many questions coming at me. I thought this would be a good format just to get as many questions as possible. We'll go back to a normal topic next week, and we're trying to keep that thing at 20, 25 minutes, maybe 5 minutes for my kids and 20 minutes for the topic. You know, we'll just roll with it. It's a lot of fun. Thank you so much. We'll see you on the other side, and have a fantastic weekend. Thank you so much. Have a great one.